Hello and welcome to my InvestEngine Stocks and Shares ISA update for October 2023. In this video, I'll start off by quickly giving a run through of how the markets have been doing over the past month. I'll then of course go into my InvestEngine portfolio and show you how it has been doing. After that, I'll take a look at some of the new features InvestEngine has and discuss some things to look forward to. Be sure to stick around to the end, as I'll reveal the major changes I'm thinking of making to my portfolio. For those who have watched my recent video, you'll know that I'm considering changing to a factor-based approach. If you haven't watched my video on quality factor ETFs, be sure to check it out, as I think you'd be surprised by the results. I'd love to hear everyone's thoughts on the factor-based ETF portfolio that I'm constructing. As far as I'm aware, I'm the only UK-based finance YouTuber who will share a factor-based ETF portfolio. I share my portfolio to be fully transparent, but also, especially in bad months like these, to reassure people that it's just part of the journey that all investors go on, and you should not expect a smooth ride upwards. If you're a long-term investor, always remind yourself that these dips really do not matter now, and if anything, it means you'll get more out of your next contribution. Remember, these videos are not financial advice or a recommendation of what to invest in. When investing, your capital is at risk and you may get back less than what you put in. If you invest in a global ETF or mutual fund, it is always interesting to see how the different components of your ETF are doing, so I'll go over all the major indices that play a part now. First, I'll take a look at the S&P 500, as that is the biggest driver in most people's portfolios, with US stocks forming around 60 to 70% of global ETFs. Looking at the chart, we can see that the S&P 500 is down just short of 4% over the past month, which I think makes it one of the worst, if not the worst month for the S&P 500 this year. And if we move over to the year-to-date chart, we can remind ourselves just how high the S&P 500 was at one point this year. It is still up a pretty decent 7.67%, but that is a lot lower than its peak back at the end of July, when it was up a whopping 20% in the year-to-date. So, what actually has been driving this dip? Well, the S&P 500 is mainly driven by those large tech stocks at the top of the index, so I'll take a look at them. By plotting the top 8 stocks, we can see that all of them apart from Microsoft are down this month. In particular, Tesla has had a terrible month with it being down over 17%. Nvidia and Alphabet have also had significant downward movements, being down 9.56% and 8.94% respectively. It is clear that the AI hype that initially led the rally this year seems to have ended. Moving on to take a look at the UK stock market, the situation is not much better, with it being down by 2.92% this past month. I'll also show the performance of the FTSE 250. Companies in the FTSE 250 will make up a tiny part of a global index fund, but for those who invest heavily in the UK stock market, it's worth noting the terrible month that the FTSE 250 has had. It is down by 6.18% this month. And if we flip over to the year-to-date chart, in total the FTSE 100 is down 3.48% this year, and the FTSE 250 is down a massive 11.85%. So not a good year at all to be invested in ETFs that track these indices. And finally, looking over at the Japanese stock market, the Nikkei 225 is also down. All around, it's been a terrible month for the global stock market, and this will be reflected in my portfolio. Without further ado, let's jump into my InvestEngine Stocks and Shares ISA and look at how it's been doing. My portfolio now stands at a balance of £13,544.03. That is up from last month's total of £13,395, but that is entirely due to further contributions and definitely not from any good performance. If we move over to take a look at the chart, we can see that on the maximum view, I am now actually down for the first time in a while, with my total investment return standing at minus £46.33. And if you're wondering why the percentage figure is positive, that is just due to the time-weighted return that InvestEngine uses. In terms of contributions, I contributed £500 on the 28th of September, and then I had a few further smaller contributions, which brings my total contributions since last update to around £615. Part of this was reinvested dividends, as I received a small dividend of £22.67 from the iShares MSCI Emerging Markets at the end of September. I said this month was terrible, and switching to the 1 month chart will reveal this. I'm down a whopping £498.77 this month alone. Amundi Prime Global is my largest holding at 85% of the portfolio, and that is down by 3.73% or £444. Taking a closer look, it is a developed markets tracking ETF, and I now have a total of just over 500 shares with an average purchase price of £24.11. The United States makes up 65.9% of developed markets, so the performance of this ETF is largely affected by the performance of the S&P 500. Returning to the main page and making sure the 1 month view is still selected, my other holding, iShares MSCI Emerging Markets, is also down, but not by as much. It is down £66.39, or minus 3.15%. Clicking into it, I have just short of 70 shares in this ETF now, and my average purchase price is £30.85. The largest holding in this emerging markets ETF is Taiwan Semiconductor Manufacturing by quite a large margin, but then you do also have large companies in China and India making up a significant part of this ETF, with China overall having the largest weighting. Going back to the main page, on the maximum performance view, you can see that overall I am down £582 in a Monday Prime Global and £97 in iShares MSCI Emerging Markets. This does not mean that these are bad ETFs. It's just all about timing, and I switched to these ETFs near the peak of this year's performance. If I stuck with these for the long term and continued making contributions, I'm sure they would do pretty well. Look at the full history of a Monday Prime Global on Google Finance as an example. It really highlights how a dip may look significant in your portfolio, but in the grand scheme of the past performance of an ETF, it is a minor blip, and there have been much worse dips in the past. The best skill you can have as a long-term investor is having confidence in the market and knowing that, although your capital is at risk, history shows that a global index tracking ETF has always recovered. So overall, a pretty terrible month, but it's just part of the investing journey. I say this in every update, but just as a reminder, the reason why my total investment return is only down by £46, despite the performance of these two ETFs, is because it also includes the realised gains from previous ETFs that I've sold, as well as dividends received. If you enjoy these updates, please drop the video a like. It really helps the channel and I really appreciate it. Moving on, I just want to highlight a few changes the InvestEngine platform has had this month, as they've made the navigation of the website and the app even better than they were before. Now when you look at the ETF range, you'll see collections, which is basically a form of categories, and it makes it so much easier to navigate the 580 plus ETFs on the InvestEngine platform. You have a collection for leading global indices, so in there you'll find all the ETFs that track popular indices such as the S&P 500, MSCI World, FTSE Developed World, FTSE 100, and many more. You also have options for money market funds, ESG, thematics, dividend-focused ETFs, which I know people are a fan of, emerging markets, small cap, and of course, multi-factor. And scrolling down, there's also an option to navigate by industries and sectors. InvestEngine's focus on ETFs and making their website super intuitive to use, combined with their zero platform fees on their stocks and shares ISA, really makes it my favourite platform at the moment. And I strongly believe that for your core portfolio, ETFs are more than enough. And I do like that by having my ISA with InvestEngine, I can't be tempted to buy individual stocks. Of course, I do buy some over on my trading 2-on-2, but I do want the bulk of my investments to stay in ETFs. Over the long term, I think I'll get some very good results. If InvestEngine looks like something you'd be interested in, be sure to check out the link in the description to get a bonus of between £10 and £50 when you invest £100 yourself. A big thank you to anyone who does use that link, I really do appreciate it. On another note, it's also looking like InvestEngine's SIPP will be released any week now, and I'll leave a link to register for exclusive early access if you're interested. Really excited for that to be released. On to the last part of the video and what I'm most excited to share with you, the portfolio that I'm thinking of switching to. Before I go over this, I just want to reiterate that I do not think the current portfolio is bad. I do not think that at all. I still believe a Monday Prime Global is a great developed markets ETF. I am complicating things because I'm seeking that extra little bit of performance, and I'm happy to have a potentially more complicated and more volatile portfolio because I'm 25 years old and I have a very long time ahead of me to ride out the ups and downs of the market. I'm also not an expert, but I'm just doing what I believe may give me a slight advantage in the long run. I'm also doing this because I want to give factor investing more exposure. It really is not talked about much at all on UK Finance YouTube. Tinkering with your portfolio too much is not a good habit, which I am aware of, and I do want to get this right and avoid making any more changes for a while. With that disclaimer out of the way, I'll reveal what I'm thinking of doing. At the moment, I'm leaning towards my largest holding being the Wisdom Tree Global Quality Dividend Growth ETF, with a 40% allocation. Dividend ETFs have a bad reputation for delivering lower total returns, but the quality and momentum filters of the WisdomTree ETF mean that it is unlike most other dividend ETFs, and it has actually delivered performance above a standard developed markets tracker, such as the iShares MSCI World. I've decided to go for the accumulating version rather than the distributing version, as my dividend itch is now satisfied by my individual stock portfolio on Trading 212. If you want to see a more detailed run through of the WisdomTree ETF, be sure to check out my best dividend ETF video. It's an ETF I think everyone should look into. I'm also debating whether to have a 20% allocation to the Xtrackers MSCI World Quality ETF, XDEQ, which I featured in my best quality ETF video. The reason to include this quality ETF as well is that it does not have the dividend filter that WisdomTree has, so it'll give me some exposure to quality stocks that do not pay out a dividend. It will also overlap quite a bit with WisdomTree. But to be honest, this is the part that I'm less sure of, and I'm not sure whether to just go with 60% GGRG rather than having 40% GGRG and 20% XDEQ. My next holding will be a value factor ETF, the Xtrackers MSCI World Value ETF, XDEV. I'm yet to make a video on the value factor, but I will be making one soon. What a value factor ETF does is include stocks that are trading at low price to book and price to earnings ratios, which could in theory mean they are trading at a bargain and have good potential to grow. At the moment, I'm considering a 20% allocation to this ETF. Next up, I have iShares MSCI Emerging Markets IMI, or ticker EMIM. This is slightly different from the current Emerging Markets ETF I have. The IMI part at the end means Investable Markets Index, and in practice this means that small cap stocks are also included in the index, which in theory, according to the size factor, should lead to better performance in the long run. I'm thinking of giving this a 10% allocation. And finally, the last ETF I'm thinking of including is the iShares S&P 600, ticker ISP6. Not to be confused for the S&P 500, the S&P 600 is an index of US small cap stocks, but it also has a profitability filter, so only small cap stocks that are profitable are included. I'll also be doing a video looking at small cap ETFs in more detail, but to summarise, my reason for including this ETF is to give me further exposure to the size factor and performance of small cap stocks. Looking at the S&P 600 website, we can see that over the past 10 years, the S&P 600 has delivered an annualised net total return of 9.48%. I'm thinking of giving this a 10% weighting. Putting all those ETFs together, I'll have exposure to 4 of the 5 main investing factors, with the only one missing being minimum volatility, which I'm not too bothered about including. Together, I think this is a super exciting range of ETFs that, based on factor investing theory, should have potential to deliver market-beating returns in the long run. Of course, it's only my thoughts, and I could always be wrong. I'd love to hear your thoughts too. Let me know in the comments what you think of this ETF portfolio, and also let me know how your portfolio has done this last month. Seeing all your comments really keeps me motivated to make more videos, and as always, thank you for watching.